Good morning, everybody, and welcome to the second core perspective of 2022. Today, I've got Tracy Jensen, that is our resident actuary within the core team, that's sort of going to help me delve into the passive allocation dilemma. Now, in the previous core perspective, we sort of delved into the drivers behind the big shift towards passive investing. If you look at the first slide, you sort of get an indication of where South Africa is on that journey. So if you look at in SA, we're currently sitting with about 5.7% in passive assets. If you compare that to the US, that's sitting at about 40%. So we still have quite a way to go. But as we illustrated in the previous presentation, we are definitely on the same journey, and we can expect the same kind of trends to sort of unfold over the next decades. If we look at advisor adoption in South Africa, the average advisor is only holding about 5% in passive investments. And you can see the average model and the average DFM allocation is slightly higher. So we're already tending towards that 10 to 20% limit. In comparison, the US advisors are already at over 62% on their equity allocations and approaching 40% on their bond allocations. And so as I said before, we're definitely going to see similar kind of trends unfolding in SA. The challenge, of course, for most advisors in SA is how and where are you going to start allocating or increasing your allocation to these kind of strategies. Now, in the previous presentation, we also covered the whole sort of the narratives around active and passive. So we sort of covered the whole initial conversation around active versus passive, the more recent one around active and passive, and then really where we sort of like got to was the whole concept of understanding that we work within a very competitive industry where effectively for any individual player, it's becoming more and more difficult to prove their value add. And that's why we sort of covered the shifts last time, whereas this time we're going to unpack the implications of that shift in portfolio construction and for intermediation. And I thought as a good example to explain that whole concept of diminishing marginal gains, I would use the gold rush there's a California, there's plenty of gold rushes across the world, and they all followed similar trends. Initially, some prospector found gold and then started mining it slowly but surely, and it's not long until thousands and thousands of people actually go onto that site and try and also extract gold. And as you can imagine, over time, most of the gold that's easily accessible is mined away, and it becomes unfeasible for most individual prospectors in that sense to actually start extracting the gold necessary for them to make a living. And it becomes far more capital intensive, becomes far more difficult to actually get to the next layers of gold. And that's broadly what's happened in the asset management industry. As the game has become more competitive, it's become more difficult to eke out additional returns. And then there's also some of the other nuances in investing that I think is often forgotten and are some of the biggest advantages that rules-based or passive or market-style portfolios have versus the active peers. Now, when we do a decomposition, you can to some extent see it. So quite a lot of effort in active management is around pricing arbitrage. It's that gray line, which is basically the change in price of the share. Now, what this slide shows, it shows the decomposition of market returns over the long term on a rolling 20-year basis, and it's decomposed into three components. It is that change in price component that active managers seek to arbitrage. Then it is the earnings growth component, the yellow line, and then lastly it's the dividend yield, which is the orange line. Now, as you can see, the vast majority of long-term returns come from earnings growth and then dividend yield, and only a small component comes from change in price. And in fact, the longer the investment horizon, the smaller that pricing component plays. And so a large part of the advantage that market-style portfolios have is they buy and hold. They focus on those two components where you're really getting your long-term growth. And this sort of like filters through into relative performances, where you can see on a recent study that's done by Morningstar. So Morningstar runs an active passive barometer on a biannual basis. In the recent one, or the most recent published one, I've sort of illustrated there on the left-hand side. And effectively, you can see that impact on longer term returns. So the chart shows you the number of active managers outperforming their passive peers. And with passive peers, I don't mean indices, but actual passive funds. So you are comparing like for like in terms of investable opportunities. If we look at the green line that constitutes all the equity funds that are domiciled in Europe, you can see over a 1 year period, it's roughly about half of the active managers outperform their passive peers. But when you get to 20 years, it's actually less than 20%. Now, as with many other things, the devil lies in the detail, and that equity summary over there actually is made up of over 100 different kinds of equity categories, from specialist categories like UK mid-caps, right up to the broadest investment categories such as the global large-cap categories. And that's where you start seeing some of the nuances. So in more specialized nuanced categories, you generally see active managers doing better. In categories where the investment horizon is significantly broader and wider, such as the global large cap category, actually only a very small percentage of active managers are successful over the long term. In fact, if you look at the 20-year number, I think it's only about 8% of active managers that successfully beat their passive peers over that long term. When you now extend the investment horizon to beyond one single asset class and you move into the asset allocation space, you see that underperformance becomes even more pronounced. So if you look at over the short term in both the cautious and the aggressive allocation spaces, you see only about 20 to 30% of active managers outperform over a rolling 1 year period. And then by the time you get to 15 years, you actually find that not one single active manager was able to beat a cautious passive fund over a 15-year period, and only about 8% of aggressive allocation funds were able to beat their passive peers. Now, many people say that this is a global phenomenon and it's not really applicable to SA. We've broadly reproduced that same concept to the SA market, where we've looked at SA equities, multi-asset high equity and multi-asset low equity. We've used our core guarded and our core diversified funds as the passive references, as they are the funds with the longest track records in South Africa. And you can see you get exactly the same kind of trend. Over a 12-year period, in fact, core guarded is the top performing fund within that cautious category. And so there's also not one active manager that's been able to outperform it. Core diversified, there's only 3% of active managers that's been able to deliver similar kind of returns. So that concept of buy and hold investing, of not doing tactical asset allocation or factor shifts, definitely has its advantages when you're truly looking at longer and longer term investments. But it doesn't actually stop over here. So as we know, the one part of the conversation is the conversation around comparing relative fund performances. But the other side of the conversation is around what the actual investor achieves, the investor return. And we've all heard about the investor behavior penalty. And there's many studies that shows that the higher the relative performance risk in a manager, or the higher the tracking error, generally the poorer the investor return, because it's such a bumpy ride. It's very difficult for investors to stay the course. And so we're going to sort of unpack that part in this conversation as well, because this is another advantage that simple market style multi-asset funds that don't do any active betting has versus many of these strategies that employ a tactical asset allocation and active stock selection. Now, when we look at how funds are practically implemented, in general, it is via some form of intermediation. There's sometimes an advisor involved, there's sometimes a discretionary fund manager involved, sometimes there's a multi-manager involved. Each of these role players, to some extent, aggregate assets. And the bigger they get, the bigger the challenge it becomes to make use of fewer funds. So the bigger your assets become, it means that you hold a much larger percentage within the funds you make use of. And so you start hitting various constraints. And so you deal with concentration and liquidity risk, and therefore you have to start using multiple funds. If you get even bigger, then you can only really look at the very large funds where your liquidity and concentration risk is mitigated. And by adding more and more funds, you start introducing fund selection risk. Now you need to go and pick the best performing funds. And as I've shown in the multi-asset space, definitely, there aren't many winners over the long term. And so the chances are that you will pick one or two winners, but the remainder of the funds that's being used will not be able to produce higher returns. And so on an aggregate basis, there's a chance of underperformance. In fact, if we look at the 12-year returns of most of the balanced funds in SA, that is actually what happens when you start having 4 or 5 funds within a portfolio. The second part is this behavioral side, which is now introducing the timing risk. So more often than not, when a fund severely underperforms for a long time and the fund is changed within a client portfolio, the fund is being replaced by a fund that's done really well. And therefore, you get this sort of like vicious circle where you're selling out of a fund that's done poorly, you're buying in a fund that's done really well, and then the reverse happens, is that the poor performing fund recovers, and then that top performing fund actually starts underperforming. And that then is another like reduction in the end return for the end investor. So then you're ending up with performance risk, which of course then has risk to that intermediated service. If we look at the various studies that specifically looks at the impact of these timing risks, and you can see it, I mean, it's pervasive across the retail market where you're dealing with individual investors, it's pervasive across financial advisors, and it is even in the institutional space where you're dealing with professional investors. This slide shows 3 separate studies, one from Morningstar, the famous long-term Dalbar study, and then a more recent study that specifically looks at ETFs, and how ETFs are used actively inside portfolios for various kinds of exposure. You can broadly see in the Morningstar study, you're looking at basically a difference in the returns of about 1.5%. So the average investor, on average, gets about 1.5% less across all funds and within asset classes compared to the fund returns. If you look at the longer term Dalbar study, you can see that's getting closer to 2%. And then the really interesting part is now where you start seeing people beginning to combine active and passive and beginning to use ETFs, and not just for passive exposure, but also to get exposure to sectors, to themes, and then or to have various factor exposures within the funds. You can actually see that they end up doing significantly worse. And this is why the conversation, to simply make the conversation about active and passive, and not really deal with the behavioral side of asset management, and then the probabilities of success associated to those behavioral tendencies, I think you can really you can get lower TERs in the end in a fund, but you're not really solving the fundamental problem of where the vast majority of returns are basically thrown away. And so to summarize that, if you basically look at your starting point as a market portfolio, it's a multi-asset, let's say core diversified fund. Generally, when people combine more than 3 or 4 funds, there will be some underperformance after costs and taxes. And now you add the timing risk, and then you see there's quite a significant reduction in the end investor's return relative to what they would have been able to get within a simple passive multi-asset fund. And so, Tracy, this is really for me where I think the behavioral side and how your fund, your financial wealth framework becomes so important to start reducing some of these risk and this reduction in return for investors over the long term.
Thanks, Yanni. I really like that you brought it back to the investor. I think so often in webinars and when we have discussions, we focus on the fund. You know, we all know comparing the fact sheets, what did this fund do over 5 years, or what did it do over 3? And we get quite focused on that and which sector did well and which market did well and, you know, what's happening in Ukraine. And I think we forget about the investor in the whole process. So I really like that you've tied the two together, and already the success rates weren't great just on a fund level. And when you take those behaviors, it's even worse. So I guess my question to you is, how do we overcome this? I mean, we want investors to have good outcomes, and I know you've got some really interesting thoughts and framework on that. So yeah, I would love to hear.
Yeah, I mean, I think that the big challenge, and that's basically what I'm going to sort of like going to be covering now, is around like managing the business risk and managing the investment risk, and then, like I said, the planning risks, etc. So I think as a starting point, it's probably useful to actually look at the main benefits of making use of multi-asset market portfolios within a financial planning context. And I think the first one was illustrated in those sort of Morningstar slides, is that these kind of portfolios have greater consistency of both the short-term and the long-term compared to their active peers. In a recent article on the core guarded fund, we showed some of the statistics on the core guarded on that core guarded fund, where, for example, over any 1 year period, it had only been in the third quartile 10% of rolling 1 year periods. The other 90% has always been above the peer average. And then when you go to longer investment horizons, from about 5 to 7 years out, it's in the top quartile. And as we've shown since its inception, it's really like within the top decile, and the top performing fund. So these portfolios, like I said, remove a lot of that short-term angst in terms of relative performance. And as a consequence, the conversation is not just about cost, although cost is a big detractor in terms of performance, but the fact that you're not trying to time the market also means that you may have a much higher probability of success, because you don't deal with those timing risks across asset classes and within asset classes. You've sort of taken all those noise out of it, and you've kept it simple, and you're basically just getting broad diversification, and you're getting that long compounding on the different asset classes and the income that those different asset classes produce over time. And so you don't miss the shares that are the surprise winners over the long term. And it's a little bit to Bill Gates's comment about people typically overestimate what will happen in the next 2 years, and they completely underestimate what will happen over the next 10. And I think that's probably the difference between if you have a buy and hold strategy versus you're trying to time the market. And then as a consequence, it also means that these funds become less onerous from an operational perspective to manage. It's easier to explain to clients, it's easier to know where the returns are coming from, because you can relate it to the underlying indices and the underlying returns that those indices are delivered. I mean, if I just take from my personal experience of seeing clients over the past decade, nowadays I spend most of my time talking about interesting financial frameworks, interesting investment-related research. People generally say that they know the funds, they're happy with the funds, and they don't really want to know a lot more about them. And I think for me that just illustrates how having a concept like the core funds, where you try and keep the concept simple, you don't go and add any chances of making mistakes, whether it be tactical asset allocation, factor allocation, smart beta, or derivative overlays, you actually get a better outcomes from a return perspective, and then really important from an investor behavior perspective. Now, as with many things, there's the theory. The question I think for most advisors is, well, now how do you practically go and implement this? And so over the past few years in the core team, we've spent a lot of time in developing a framework, and a framework that also takes other behavioral tendencies of South African investors particularly into consideration. I mean, the whole offshore dilemma of seeing South Africans panic during a Nenegate and then moving their money offshore at the worst possible time when the exchange rate is blown out completely. And I mean, this has happened multiple times over the past few decades. And so we've gone about and designed such a framework in a very simplistic manner, but by taking all the really important financial considerations, such as your concentration risk, such as volatility, such as income withdrawal, and then, of course, really importantly, taxes. So where do you want to save your South African taxes? Where do you want to save or where do you want to save on South African taxes? Where can you save on global taxes? And we've sort of taken that all together into this framework. And basically, there's 3 broad buckets. The first one is just dealing with your short-term liabilities. This is emergency saving for a home or car that you're going to purchase over the next 5 years. Then when you're dealing with longer-term liabilities, of course, the biggest long-term liability that all of us have is retirement. Then the last part, which is really the long-term wealth creation. So this is generally money that won't be used or may not be used within your own lifetime, and will probably be passed on to a beneficiary. Each of these buckets have got their own forms of risk management. So on the short-term liability side, of course, is your short-term insurance. So it's your short-term, if you have a car accident or something happens at home, etc., that covers those income challenges. Over the long term, of course, the really important thing is stuff like death and disability cover, to make sure that there is an income that will be paid to beneficiaries if something happens to you. And then when it gets to the long-term wealth creation, that kind of the risk management almost like changed changes to the investment to some extent. And that's really where diversification becomes important. And that's really why you'll see when we look at the international exposure in each of these buckets, that for short term, you have a much smaller percentage, generally within the Reg 28 funds, where people are both saving for retirement and withdrawing from a fund. We've broadly calculated that the ideal exposure sits between 40 and 50%. And then for long-term wealth creation, you really want to get the most out of that diversification that international investing offers you, so it's more than 50%. And the idea is that throughout an individual's lifetime, they actually allocate their wealth to these different buckets along these sort of like broad lines. And in this way, people are continuously allocating to offshore, and it doesn't become a single point in time where they have to time the markets. And then, like many other investors that moved their money off in 2001, 2002, the rand strengthened to such an extent that all the global gains on the global investments was basically wiped out. And so in this way, you sort of get the benefits of dollar cost averaging, but you also get a better overall risk management of the individual's portfolio. Now, the second layer, in terms of beginning to start unpacking how would you allocate passive within each of these buckets, has to do with the advice risk that's associated to each of them. Now, when we sort of like break it down, advisors' greatest risk definitely sits within the compulsory space. It is a space where the rules and goals are very clearly defined by regulation. There's a lot of scrutiny on fees. And really, if you make a mistake in this space, it can have dire consequences for the individual. So if you think, for example, to that slide that I showed earlier around reduction in turn. So if a lot of churning happens in the client's portfolio and the client ends up getting 2 or 3% less than what that long-term return of a typical market portfolio will be, that will have different consequences on the longevity of that individual's retirement assets. And so the outcomes are far more dependent on making sure that as few mistakes are made as possible. Also, from a business perspective, increasingly advisors have to come up against default pre- and post-retirement offerings that are basically priced at institutional fees. And so all three of those sort of are things that have to be taken into consideration. If you compare that to on the discretionary side, it's generally for different needs, short or long term. There's more discretion, and it's more sort of like room for the individual's personal preferences, their personality, etc. And then the options is also much broader. You can go into alternatives, etc., which of course comes with their own risks. And so what we've developed from these to the long-term strategic asset allocation model, and then the risk, and then the research on the passive, we've come up with a tiered approach to sort of like approaching the inclusion of passive, where our almost default is our market portfolios that are low cost, have high probabilities of achieving outcomes. And you can see really where that plays. It isn't sort of that medium term in the short term liabilities where you can't really do cash and fixed income or the multi-asset income kind of portfolios really in a passive manner. And therefore that is really the domain of active managers. But then in that sort of like 2 to 5 and then the pre and post retirement is really where you're going to get the highest probabilities of success of making use of market style portfolios. And then on the global side is really where there's a little bit more discretion, where you can make use as your starting point is a low cost global equity and global balance funds. And then they can sort of be supplemented with a global active, both equity, property, and flexible mandates. But broadly speaking, if you apply this framework, you're going to basically end up with approximately 50 to 80% in passive in an individual client's portfolio, depending on their needs, etc. So if somebody doesn't have a lot of discretionary investments, they'll probably be closer to the 80%, as most of the investments are within that retirement side. Now, Tracy, this is really where you've done quite a lot of work over the last few years, both in terms of how do you get the best possible outcome from an investment perspective, but also incorporating the behavioral side into the journey when you have a conversation with a retiree, for example, in MRS.
Thanks, Yanni. So, as Yanni mentioned on the slide before this, what we haven't covered in the framework is client personality and risk preferences. And that's really where it gets tricky, because traditionally what's often been done is this framework has been adjusted to account for that. And what I'd really like to take you through today is how you can look at that differently and have a different discussion with clients, or if you are an investor, how you can view it differently and rather frame it as trade-offs. So here's an example. Let's say I'm saving 1,000 Rand every month. I'm pre-retirement. We'll cover post-retirement in the next slide. And I've got a goal to get to 1.5 million in today's money. That's what I need to retire on. So traditionally, you can say to somebody, for example, how would you respond if you had 1 million Rand and the market fell and you've got 800,000 now a few days later or a week later? How are you going to feel about it? So that's sort of the more traditional approach. But what I've found the most useful thing in the pre-retirement space is to frame it in terms of contributions, because it really talks to affordability. And as we know, people do struggle to save because it means giving up things they want now. Now, if you frame it in that context, what we did is we looked at all different periods going back to 1926, and we said, on average, how much would you have needed to contribute? So we looked at 3 options. On the left, we've got a low equity fund. In the middle, we've got your standard high equity fund that you would typically see in the pension fund or an RA. And then on the far right, we've got what's called a Max Reg 28 fund. So that's got about 90% in shares and property. So you've got effectively, in your traditional terminology, from low risk ranging to high risk. So let's say your client comes in and he says, okay, his goal's 1.5 million. That's what you've worked out he's going to need to retire. If he's going to go low equity, he needs to save about 1,500 a month on average. If he went high equity, it's only about 800. And if he went max reg 28, it's 650. So I find when you start framing it for a client in a way that they actually understand that's meaningful to them, meaning I'm going to have to find, instead of paying 650 Rand a month as per the framework, I need to find an extra about 800 Rand a month to get to where I need to be. That becomes a lot more meaningful. And I've seen that people's decision-making changes when they understand it in that context. Now, of course, the next part is, well, what about the risk? So that's great on average, but, things can go really badly. And there's 2 ways you can look at it. You can either say, what is the highest contribution you would have ever had to pay in history to reach your goal? Or another way you can look at it is, what is the lowest asset value, and again, it's in today's money, that I would have got at the end of the 40 years. And if we focus on that one, in a low equity, the worst ever, you only had 600,000 by the time you needed to retire. High equity, you had 900,000. And then in the max reg 28, you had about 1 million. So again, even on what is the worst outcome ever, you're still better off going in a max reg 28 fund. So if we move over now to the post-retirement space, and here I often hear people say to me, but it's different because I'm taking withdrawal. And it is a little bit different, but it's not as different as you think. So the conversation is often, because I'm taking a withdrawal, the order I get my returns in is really important. And if returns are poor initially, I'm going to be in trouble. So we're actually going to be covering that topic, sequencing of return risk, in a webinar later this year. But to take you through it in this context, again, we've taken 3 funds, low equity, high equity, and the one we're showing here was pre the change in offshore regulation, so it's got about 30% offshore. And then on the far right, you'll see it's not a max reg 28 fund in this context because we're talking about retirement, but it's a high equity fund with half offshore and half local. So in fact, our core diversified fund we mentioned there currently has 40% in international because, as I said, the legislation changed. So you're looking at somewhere between the middle and the chart on the right. So let's take an example here. John, he's retired. He's come to you and he has 1 million Rand. And he's heard of the safe withdrawal rate of 5%. So he says that's what he's going to do. He wants to make sure his money lasts for the next 30 years. And he would like his income to grow with inflation. And let's look at how his income lasts for the 3 different funds. For the very first one, the low equity fund, it's 28 years, so not too bad, almost the 30 years. But in the other 2 funds, it's 40 plus. So, I mean, if you look at it on average in all different scenarios since 1926, not that bad. But again, talking to reframing the conversation, if you look at those success rates, the low equity has just over 50%. So that's like flicking a coin heads, I'm okay, but if it was tails, I'm not okay. So, it's not a great way to plan for your retirement. Yet often sort of the urban legend is I should be more to the left to a lower equity fund because I'm taking a withdrawal, and that's not the case. Another way you can frame it, and it all depends on the client and their specific concerns, is to say, in the worst outcome ever, how long did my money last? As in, on the day my balance hit zero. And for low equity, it was 19 years. For your typical high equity, it's 18, so not that different. But if you add that offshore diversification to Yanni's framework and making sure that you get things right, it was actually 21 years. So I'm not going to cover all the different ways you can position it because each client is different and you would pick which one works for them. But you see the same story in terms of drawdown rates, and even in terms of the lowest drawdown rate you could have ever taken and still made it, that the high equity fund with 50% offshore still gives you the best outcomes. So this just gives you some idea of how you can get clients and manage the behavioral aspect of those clients to still get them into the correct framework, as opposed to adjusting their shares and the asset allocation according to their concerns and risk levels. The one aspect we haven't touched on today, and we're just going to touch on it briefly before we wrap up, is that investment returns are not your only source of return. And this slide is relevant to people who are retired. So in a traditional product in the living annuity that you see there, you will notice that the fund can only really grow with returns when they're positive. They're not always positive. And your income is obviously being taken out. So we've developed something called the Living Annuity Plus, where it not only grows with returns when they're positive, but you also get top-ups coming in every month. So every month there's payments made into the investments, and that percentage top up grows as you get older when you need it most. So that really helps with that behavioral aspect of, I know I've got regular money coming in. But I always find it interesting because when I present this to people in the industry, they're always like, where does it come from? There must be something behind it. So as economists say, there's no such thing as a free lunch. So where it comes from is that clients elect to give up a percentage of their inheritance on death. So let's take that example of John's million. It's still his million. He earns returns on the million. Maybe he has 100,000 left at the time he passes on. It would be a percentage of that 100,000. So there are also alternative ways, and this can also help manage your client's behavior. So yeah, those are just some examples of ways you can position it, specifically in the retirement space, as Yanni said, which is the higher risk space. And I'm going to hand over to him to pull it all together and wrap up for the day.
Thanks a lot, Tracy. So I think what we've clearly illustrated in this conversation is that the benefits of multi-asset market portfolios in financial planning in terms of achieving better outcomes and removing that underperformance and timing risk. And I mean, as we've shown, is that those can be quite material. I think the second part, and I think this is increasingly becoming important for advisors in dealing with all the regulation that we are subjected to, is that it is less onerous to monitor. There's less time and effort that needs to be placed to understand the product and over time have to explain underperformance. And then the third really important one is the one that we've sort of harped on, which is the whole behavioral side, and which we believe is really where advice plays a really important role. And then firstly, like I said, part of that framework is having a strategic asset location framework so that you can deal with the offshore dilemma for a South African investor, and you're not sort of like subject to the rand moving up and down, and when it's down you suddenly want to take money offshore, and then next time when it's up again and you're panicking, you do it at the worst possible time. So by removing that and sort of like understanding the role of global diversification from a risk management perspective, you end up sort of like removing the big penalties that's associated with getting the timing wrong. And then really to Tracy's point, is really finding guaranteed additional sources of return. I think a lot of effort has been placed in the past on active returns and picking the right best funds, etc. And I think it's increasingly becoming clear that none of those are guaranteed. In fact, more often than not, once people start diversifying across too many strategies, they almost always end up on the negative side of that equation. And so focusing on things of additional sources such as the mortality credits that Tracy's just talked about, and then really making sure that your costs and taxes are done as effectively as possible, because that is a guaranteed reduction in the cost that normally gets deducted from your returns. And so it's almost like it's focusing on the things that you can control and then putting a framework in place to really make sure that those human behavior that affects all of us, I mean, whether you're an investment manager, whether you're an advisor, whether you are another form of intermediary, reduces those sort of the harm that you can do to your investors' money. We thank you for attending our webinar today. And then, as Tracy said, the next one will be in August, and that will cover sequencing risk during the retirement income stage of individuals' lives. Thank you.